industrial average is down nearly 500 points this week, or 3%. It's second worst weekly loss in 2 years. What's driving the markets lower, and how could it impact your wallet? Here to lend some insight is Matt Roddy, Vice President and Portfolio Manager with Rockland Trust's Investment Management Group. We appreciate you being with us today.
Thank you for having me, Mark.
I wish it was better. I wish we had green arrows across the board and hundreds of points higher. It's not the case, but break down why we've had this dramatic drop here towards the end of the week.
Well, believe it or not, it's actually probably more good news that caused it, and some lack of clarity a little bit from the FOMC, the Federal Open Market Committee. Really, we had a 4% GDP print earlier in the week, and that's a positive. But what it also did is the FOMC commentary sort of indicated that was a little less clear on when they might raise rates. And really, the Fed has been on autopilot for quite some time. You know, they've kept rates low. We've done a $10 billion taper in the bond purchasing for several months now, and that's going to wrap up soon. And when that wraps up, we're really going to be in a situation where, the question remains, when will they raise rates, how soon? And with good economic numbers, it makes people think maybe that's going to come sooner rather than later, and it makes the market a little concerned as to how that might impact it. You throw in a little bit of uncertainty, geopolitically for sure, everywhere. An Argentine debt default in the emerging markets, and the economic sanctions in Russia, and you're going to have a little bit of a pullback after the run we've had.
And let's talk about how this impacts people, and more specifically their 401ks, because when you see a precipitous drop like this, you are going to see your balance is not looking like it did before, unless you had some idea of how to play the game a little better than others, I guess.
Yeah, I mean, the average investor, if they're aggressive, they lost somewhere in line with the markets of 3%. They should be able to withstand that. If you're in a balanced portfolio, you'd lose maybe half of that. And if you're conservative, you might actually made a few bucks or barely lost any, like a conservative investor wants to do on a consistent basis. So I wouldn't hope that this would impact the average investor too much. If it does, they should really check their asset allocations against what they're trying to accomplish, and maybe sit down with someone if they're uncomfortable with things.
You know, some people want to check it every day. I hear that's not a good thing. But on a day like this, you can understand, especially after yesterday, 316-point drop, people are going to go click on the mouse there and make sure they see what they've got or don't have, more specifically.
And, I don't believe that they shouldn't check it. I just think that they shouldn't worry about it. And if they're worrying about it, they don't have the right asset allocation. So I think checking on it's fine. Looking at your investments, make sure they're performing in line with what they're expected to do. And if you don't have a real understanding, you don't have the time to understand what they're expected to do and what you're trying to accomplish, sit down with someone. But, if you do know what you're getting into, and you've got sound investments and you understand the risk profile, I would say, yeah, check it. Make sure it's doing what it's supposed to do.
We're talking about a 3% correction this week, but really, correct me if I'm wrong, but to get into bearish territory where people would be really shaking their heads, it'd be 10% or more, correct?
Yeah, 5 to 10. Well, 10% actually is considered a correction. 20% is a bear. Typically, I would tell people not to do too much in the 3% correction like we've done now. But if you get to that 5 to 10% range, start to think about rebalancing back to targets, taking advantage of things. As things go up, they should have been trimming, and as things come down, they should be adding. If they're willing to stick it out, that's really the opportunity that we would advise people to do. So 3% is probably a little early to do that, but 5 to 10, you can start to take a look at it and keep going if it continues to kind of go down on you.
Let's go back to what you talked about earlier, which I thought was good because it's positive, and that is the GDP growth was good, which is a big number, of course, obviously, for the markets, but also jobs. We've had, 6 consecutive months, first time since '97, where it's been 200,000 jobs or better?
That's right, yes, and the average has been about 248, I think. This week's number was 209. 209's was a little lower than consensus, so there was a little disappointment. That probably didn't help us too much today. I actually would argue, though, that if the number was really strong, we might have had a worse day. I know that sounds strange, but that would start people talking about raising rates sooner rather than later, and that would get the markets jittery. Going back, one question, though, if I could,
Sure.
Back to that wholesale and just tweaking around the edges. One thing I would advise investors not to do, don't make wholesale changes like the Red Sox did in the last couple of days. Just do a couple tweaks and you'll be all right.
Very good. We'll leave it at that. Matt Roddy is the Vice President, Portfolio Manager with Rockland Trust's Investment Management Group. Have a great weekend. We appreciate it.
Thank you. You too.
Thank you. Let's hand it over to Savarni.
All right. Thank you so